Welcome to the Coin Bureau Weekly News Roundup. My name is Jessica.
And my name is Guy. Here are the top stories in crypto this week.
Crypto rally returns, coins and tokens pop after the US government averts a shutdown, leading to speculation of more fiscal spending. How long will this recovery rally last?
ETH levels up. The ETH stolen from FTX starts to move, while the SEC finally approves a futures Ethereum ETF as asset managers promise to fund developers. What effects will this have on ETH?
All about stablecoins. Circle backs Binance in its case against the SEC. Binance works to launch a Japanese stablecoin, and USC launches on Stellar. Everything you need to know.
High DXY. The US dollar rallies for 13 weeks straight, causing investors to wonder when the rally will end and how it will impact the markets. Why the greenback may continue to rally.
And a closer look at last week's top performing cryptos and where they could be headed next.
All this and more in just a moment. Last week, the crypto market rallied, and by last week, I mean over the weekend. Prior to the weekend, the crypto market had actually been crashing, with BTC being on the brink of breaking below 26k. Now, it appears that the delay of the US government shutdown is what brought BTC back from the brink, so to speak. This makes sense considering that a government shutdown would basically mean that the government stops spending, and if the government stops spending, that's less money being injected into markets and the economy. For context, it's believed that this fiscal spending is basically keeping everything together. In any case, we will get to ride this roller coaster again come the 17th of November, when the current extension expires. What's interesting is that this extension excluded additional funding for the war in Ukraine. This is interesting because it suggests that the next negotiation will result in more cuts to fiscal spending. If this is the case, then a resolution to the next government shutdown may not be as bullish as the one over the weekend, nor any subsequent resolution. Each additional negotiation would involve politicians gradually agreeing to less spending, which could start to weigh on the markets and the economy. Now, the silver lining to this outcome is that it would likely cause inflation to come down and could cause the labour market to weaken to the point that the Fed pivots, i.e. starts lowering interest rates again. Obviously, this would be extremely bullish for the markets, particularly the crypto market. But this is only something that would happen later this year or early next year. In the short term, it looks like the markets will continue to be choppy, including crypto. In BTC's case, it seems to be battling with the Bollinger Band moving average on the weekly, a key level over the last couple of years. As you can see, if BTC gets back above this moving average, then it's likely that it will hit new local highs and potentially prepare for a new all-time high. If BTC gets rejected at this moving average, however, then it could confirm lower lows the same way it did back in the spring of 2022. Notice the parallels. On that note, BTC's price action on the monthly looks eerily similar to what we saw in 2022, albeit a lot more compressed. If we see a similar pattern play out, then it could be a nasty October and November for the crypto market. That said, October has historically been a good month for crypto. The caveat this time around is that we have no shortage of tail risks that could bite the market. And the pond they're playing in is Sam Bankman-Fried's trial, which begins later this week and will last until the end of the month. It's quite possible that we will see bombshells coming out of the courtroom. This seems to be more than speculation too, because the unknown entity who exploited the FTX exchange after it collapsed moved millions of dollars of ETH over the weekend. Now, this could just be a coincidence, but it's possible that this exploiter is preparing for what could be revealed in the case. For those unfamiliar, FTX was exploited shortly after the exchange filed for bankruptcy. This has led to speculation that the exploiter is someone who worked at FTX, which certainly seems to be the case. If it is, then it makes the sudden movement of ETH before SBF's trial that much more significant. Fortunately or unfortunately, this news has been overshadowed by the announcement that crypto asset manager Valkyrie has received SEC approval to list its Ethereum futures ETF. It's believed that the SEC will now approve all other Ethereum futures ETF applications, like it did with the Bitcoin futures ETFs. The approval of Valkyrie's Ethereum futures ETF is somewhat strange, considering that the company only holds around $1 billion of assets under management, and that's according to 2022 statistics. Not only that, but Valkyrie's largest client reportedly was, and still could be, Tron founder Justin Sun. This makes the approval of Valkyrie's Ethereum futures ETF even stranger, especially when there are other established asset managers still waiting in line with their own applications. One of these is VanEck, which holds roughly $80 billion in assets under management and has many crypto ETFs. Speaking of which, VanEck recently announced that it plans to use 10% of the profits from its Ethereum futures ETF to fund Ethereum development, once it's approved, of course. This is bullish, but also somewhat concerning, given that it could give VanEck huge influence over Ethereum's development. And if that wasn't concerning enough, VanEck called on other asset managers to do the same. So, if they decide to follow suit, we could soon see BlackRock using a portion of its spot Bitcoin ETF profits to influence Bitcoin's development. Remember what their filing said about adjusting the ETF to Bitcoin forks. You can learn more about how institutional investors are trying to take control of Bitcoin using the link in the description. But I digress. Back to Ethereum. So, this begs the question of whether the approval of a futures Ethereum ETF is bullish or bearish for ETH. If the approval of the Bitcoin futures ETF is anything to go by, it's bearish. That's because it effectively marked the top for BTC during the previous bull market in 2021. Of course, history doesn't repeat, but it does rhyme, and I see a limerick on ETH's price chart. Similarly to BTC, ETH appears to be rallying towards the Bollinger Band moving average on the weekly. It's possible, if not likely, that it will hit this target in the next week, which would be a nice pump indeed. However, it's possible that it will get rejected at this level, and this makes sense when you consider the order of events. Ethereum futures ETFs will list in the next couple of days, with SBF standing trial towards the end of the week. Recall that there will be no shortage of catalysts there. So, if you're planning on trading these catalysts or hodling through them, be sure to check out the Coin Bureau deals page. It's got up to $40,000 of airdrops on the best crypto exchanges and the biggest discounts on the most secure hardware wallets. The link will be down in the description, so be sure to check it out. Now, this calls to mind another overlooked fact, and that's that stablecoins continue to face regulatory scrutiny in the United States. If you watched our video about SBF's secret bank, you'll know that Alameda Research was the largest recipient of all the USDT ever issued. This likely means that SAM has info on stablecoin issuers. This puts into perspective the news of Circle essentially stepping in to support Binance in its case against the SEC. As you might have guessed, Circle is arguing that Binance's BUSD stablecoin is not a security because it does not have the features of an investment contract. This is significant because Circle is closely affiliated with Coinbase, which is Binance's top competitor. Not only that, but Circle's USDC stablecoin is, or rather was, a top competitor to Binance's BUSD and continues to be a top competitor to offshore stablecoins like Tether's USDT. As such, Circle stepping in to support Binance against the SEC is not something I had on my crypto bingo card, but it does make sense. Circle is concerned that the Binance case will set a precedent for the SEC to go after stablecoins like USDC, which is something we've been warning about for months. The fact that Circle is throwing its weight behind Binance could be a sign that the regulatory scrutiny is worse than we think, and this too would make sense. If you watched our video about the Fed's warning to banks, you'll know that any banks working with stablecoins are under scrutiny as of, well, now. To refresh your memory, all US banks must inform the Fed about their stablecoin activities by early October. In other words, this week. Soon, the Fed will start issuing so-called non-objection letters to banks that are allowed to work with stablecoins. As for all the others, well, nobody knows, but it's probably not good. But this is just what's going on in the United States. Elsewhere around the world, governments are not so subtly supporting stablecoin development, probably because most stablecoins are backed by government debt. This makes stablecoins a great way to subsidize government spending. This would explain why Japan is completely comfortable with crypto companies like Binance exploring yen stablecoins, despite all the regulatory scrutiny. Newsflash, but Japan has the largest debt to GDP of any country. So, if you're willing to create a yen stablecoin and advertise it, you're probably Japan's best friend. The same is true for Europe, where Circle has been gaining ground. If you've been keeping up with our coverage of European crypto regulations, you'll know that they seem to have been heavily influenced by the stablecoin issuer. You'll also know that USD stablecoins could soon be banned in the EU. The consequence of this is that Euro stablecoins will likely see significant growth, and Circle is perfectly positioned to capitalize on this. The stablecoin issuer has been launching its recently rebranded YourC stablecoin on multiple crypto blockchains, and the latest one is the one and only Stellar. Given that Stellar has a partnership with MoneyGram for Circle's USDC stablecoin, it's possible that we'll see the same kind of partnership for its YourC stablecoin. It's safe to say that the ECB would love to see it. A euro stablecoin will allow it to subsidize the debts of its poorer member governments. This ties into our macro topic of the week, and that's the US dollar as measured by the DXY. FYI, the DXY compares the value of the US dollar to a basket of currencies of the US's main trading partners, mostly the euro and the yen. This means that a strong DXY doesn't necessarily mean a strong USD. Sometimes it means a weak euro and yen. This makes the 13-week rally we've seen in the DXY a little easier to understand. At first glance, it appears unprecedented, but upon closer inspection, it could very well be a consequence of Europe and Japan selling their national currencies to purchase energy, which is bought and sold using US dollars. According to macro analyst Luke Groman, this is exactly what's happening. In case you missed the memo, oil prices have been rising. This means that countries which import most of their energy, such as those in Europe and Japan, have had to sell more of their national currencies to buy more USD to buy oil. If Luke is correct, then it's possible that the DXY will continue to rally so long as oil prices continue to rally. This seems likely, considering that OPEC, the coalition of the largest oil-producing countries besides the US, has committed to cutting oil supplies until the end of the year. Meanwhile, Russia has reportedly banned diesel fuel exports. In case you missed that memo, there's already a global diesel shortage, and diesel is required for everything from shipping to manufacturing. What's worrying is that Russia hasn't set a date for when it will resume exporting diesel. From Luke's perspective, oil and diesel shortages will be rocket fuel for the DXY, and this will likely be the case even if his thesis is incorrect. That's simply because higher oil prices will eventually cause inflation to rise again, and this will force central banks to raise interest rates again in response. The possibility of a second wave of inflation is believed to be the reason why the US bond market has been falling apart and why long-term interest rates have been rising. In short, bondholders are demanding to be compensated for higher inflation in the future with a higher interest rate. This could become a problem for everyone who holds large amounts of US-denominated debt, including the US government itself. Some macro analysts believe that long-term interest rates will spiral out of control as foreign governments sell bonds for USD to defend their currencies while buying energy. Whatever the case, history suggests that the outcome will be the same. The Fed will eventually have to step in and start buying US bonds to bring long-term interest rates back down. This is exactly what the Fed did at the start of the pandemic, and it was the catalyst for the ensuing crypto bull market. As always, the only question is when. When will the Fed be forced to start printing money again? Well, nobody knows for sure, but one thing is for certain. A lot of money was printed during the pandemic, and most of it is still sloshing around. This could have made the economy more resilient to higher rates. This has been the case so far when it comes to short-term interest rates, so it wouldn't be surprising if it was also the case when it comes to long-term interest rates too. What could be surprising is how high long-term interest rates could go and how long they could stay around before something breaks. So, with all that said, let's now turn to last week's top-performing cryptos. Jessica, take it away.
Thanks, Guy. Well, last week's top-performing cryptos were GMX, MakerDAO, Compound Finance, Solana, and Pepe. Starting with GMX, it appears to have pumped on the news that the BitGet wallet has integrated the decentralized derivatives exchange. Note that BitGet is one of the best derivatives exchanges out there, and you can get a huge discount on trading fees on the Coin Bureau deals page. Anyways, GMX appears to be struggling to stay above the $40 level, which makes sense given that it's a historical zone of both support and resistance. GMX is still below the Bollinger Band moving average on the weekly, so it could rally a bit higher before being rejected, which is not guaranteed. Next up, we have MakerDAO, whose Maker token appears to have pumped because of an executive vote to make major changes to the assets backing DAI. The details are outside the scope of this video, but we'll leave a link to the full governance proposal in the description if you're interested. Now, Maker has seen a massive rally over the past few months. This is due to its buyback mechanism, which makes analyzing its price action difficult to do so. For what it's worth, Maker faces a lot of resistance around these levels. It therefore seems unlikely that it could go much higher from here. When it comes to Compound Finance, its comp token appears to have pumped for unknown reasons. Our best guess is that it has to do with the recently approved Ethereum futures ETF. It's likely that lots of ETH holders are taking additional leverage in DeFi due to the recent ETH rally and bullishness. Comp's price action looks just as confusing as the reason it's rallying. As you can see, its price action has been very volatile lately, though it has been trading sideways overall. Hitting the Bollinger Band moving average on the weekly could mean that a rejection is coming, or that Comp is about to break through. It could be a similar story with Solana. Its Sol coin could have pumped because of the news that one of its competitors has secured a futures ETF approval. It also could have pumped because of all the events leading up to Solana's annual Breakpoint conference, which will take place later this month. The difference is that Sol has broken above the Bollinger Band moving average on the weekly, which means that it could see another week of gains. Come to think of it, this could be a contrarian indicator regarding what Guy said earlier about bad news coming out of SBF's trial. We'll see soon enough. Finally, we have Pepe, the meme coin. As you might have guessed, there has been literally no reason why Pepe token pumped. The Pepe Twitter account has been dormant since early September, and there has been no notable news or updates. If you know something we don't, drop a comment down below. Now, in terms of price action, Pepe is looking overbought on the daily and also seems to be having a hard time getting above a key level. Oddly enough, Pepe looks like it could be reversing from its lows, but it's much too soon to tell, and it's more likely that this price action is pure manipulation. If you want to know why cryptos are pumping in real time and where you can trade them, make sure to join the Coin Bureau Telegram channel. The link will be down in the description.
And that's all for today's Coin Bureau Weekly Crypto Review.
If you enjoyed it, you know what to do. Hit that like button, subscribe button, and bell icon too.
Don't forget to check out our deals page where we have massive discounts and airdrop bonuses of up to $40,000 on some of the best exchanges, only for the viewers of this channel.
You can find the link to that resource and many others in the description below.
So, thank you all so much for watching, and we'll see you all in next week's episode.